Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Volatile times indeed. Maybe one asset class exposure or a larger exposure to one favorite asset class might not be the right thing to do in a scenario like this, despite the fact that equities have had a really good time over the last 24 odd months. So, is there an alternative? Is that alternative a better alternative? Is a combination of multiple asset classes the right way to go about? Or is equity still, or will equity still triumph in 2022? Let's pose all of those questions to Anshu Kapoor. He's President and Head of Investment Management at Edelweiss Wealth, joins us right now on the show. Anshu, great having you. Thanks for joining in. Hope all is safe.
Thank you. Thank you, Neeraj. Yes, all is safe and great to be with you, Neeraj.
Yeah, likewise, Anshu. Great having you. You guys are amongst the largest wealth managers in the country and therefore potent to get your view in times like these. What is it, Anshu, that you must be telling your clients when they ask you about the very question that I posed or I started off the conversation with?
Right. Yes, obviously, last at least 2 years have been quite interesting from a market standpoint. And when customers are asking us this question, certainly there is this little bit of uncertainty in their approach, uncertainty in what they need to do. And when they've come to us and we've said to them, listen, look at the economic cycle and look at the market cycle. And maybe, obviously, we know that they're correlated, right? And when we see the economic cycle, our view is everything is fine. There is nothing to worry about right now. Maybe the market cycle has changed. And just going back to the economics, we are in a good environment right now. The problem is supply is not there. Demand is very solid. So it's a good problem to solve, in our opinion. Global trade is booming. Our households and corporate balance sheets are in place. There is a great support from the government in terms of driving the country, the economic policy forward. So I think economic conditions are quite favorable. Yeah, it remains to be seen whether this whole rate hike and all of that will really damage or not damage the situation. But the market cycle has changed. And that is a big difference going into 2022. And I think we talk a little less about investor psychology, but that is what seems to be at play here. So there was this huge build up, follow the crowd, get into the next investment opportunity, fear of missing out, and all the classic signs of creating a pendulum, a market pendulum going into an excess. And what is happening right now is it's reversing from the excess, and therefore it's creating some not panic, but uncertainty in the minds of investors, because what they think, where we valued certain investments, clearly have corrected from where they were in an excess or exuberant environment. So, the long answer to your short question is that right now we are telling investors to change their stance. And when I say by changing your stance, I mean focus on minimizing losses rather than maximizing gains. Right. And that's a big difference in approach over the last 18 months. Over the last 18 months, the conditions were so easy and conducive that you would focus on catching up very quickly. Now, avoid mistakes. And that's the theme for us in 2022, Neeraj.
Interesting. So, Anshu, let me kind of still take a step backward. So, when you look, I'm presuming you look at multiple quadrants for all your wealth clients, HNIs or ultra HNIs, as the case may be, and you divide it between, say, fixed income, equities, maybe a bit of real estate, and so on and so forth, and maybe crypto. I don't know, but so how have the allocation percentages changed between the quadrants? And I know it will be different for different clients, but largely as a summary, what is the broad change?
Yeah, and that's a good question. Thank you, Neeraj. And it's pertinent because from 2021 going into 2022, we dialed back on equities a little bit. So in our aggressive profiles, let's say equities were at peak about 80-85% of the asset allocation. So we've dialed it back to, let's say, about close to 70%. And for a moderate profile, equity would have been dialed back from about 55% to about 45%. So we have dialed back. Within that, what we have done is we have kind of reduced exposure to small caps and mid caps, just to protect from volatility. And also the additions we made was international equity, and to give diversification to Indian investors. And so that is on the equity side. On the fixed income side, what we have done is we've encouraged investors to look at opportunities in REITs or InvITs to create some kind of a return profile when it comes to yield on their portfolio, because yield is hard to get right now across the world. And post-tax yields on all kind of investments are less than 3 to 4, 5%. So how do you create yield on your portfolio without damaging the quality of your portfolio? So right now we are AAA completely, largely AAA in our fixed income profiles. And as far as the little bit of diversification is concerned, is going into REITs and InvITs. We have done a little bit of what you call late stage private equity, just to give again diversification to our customers. So what we are trying to do, Neeraj, is to diversify in high quality and not really trying to add risk. At the same time, what we are trying to do is protect the customer from volatility, extreme volatility. And that is where we are positioned right now as we go in.
Interesting. A couple of follow-ups, Anshu. The equity portion, and I'm taking a moderately risk-taking investor, wherein the equity percentage is 45%. You mentioned that you're also adding some bit of international equity to it. So how much within the equity portfolio is international equity? I'm presuming this 45% includes international equities as well.
Yeah. So Neeraj, it's about 7 to 10% right now. And if you see the international products that are available right now, we have a lot of good quality products available right now. And I've been saying to our customers for a long time now, India is about 2.5% of world GDP. So why ignore the 97.5%? And therefore take early steps in diversifying away your risk, and also get exposure to themes that perhaps are not available right now in India in the listed markets. So you can go. So the idea is to go broad. So initially give clients exposure to global indices, the S&P, NASDAQ, the MSI, and so on. And then maybe go narrow in more aggressive profiles where we can talk about themes. Clients want to talk about EV or robotics or automation or software or AI. So you can go narrow once you build your broad allocation to international equity. So that's the approach. And I think this will catch on. And if just to share with you now, international feeders and mutual funds are about 50,000 crores. 70% of that has come in last 2 years.
Wow.
So there is definitely a demand. I think it's a good direction.
Okay. Fixed income yields, Anshu, you mentioned that yield is very hard to find. They are at the levels where they are. What can investors do to increase the yields on the portfolios, therefore?
My recommendation is not to take any undue risk. And in fixed income, the mistakes are very costly because it results in maybe wiping out your capital and not only the interest. So my request to clients has been that we be very judicious and thoughtful when you diversify away from AAA in India, because that part of the market is still coming up the curve, even though spreads are very interesting. So just be careful. Do not get carried away for 1 or 2%, because net of tax anyways, it doesn't add too much. And like I said, we are in a interest reversal cycle. So right now, do not add duration. Don't get trapped into duration. Just stay AAA. I think wait for the time to be right before you start building maybe a AA portfolio and so on. Until that time, keep experimenting. Like I said, with REITs. REITs are giving you about 6.5 pre-tax yield with some capital appreciation, and InvITs are giving a little higher. So diversify into those areas where you can get a little bit of a yield. But right now, this is not the time or the environment to start building duration or getting to G6 and all of that. Like I said, we do not know the pace of tightening. I mean, we know interest rates are going up, but how steep that will be, we don't know. So therefore, be cautious for the next 3-6 months, see how it plays out, and then build your portfolio around that. But this is a pain point. It's a pain point for investors to solve.
Yeah. In the first answer, Anshu, you mentioned about how investor behavior is not spoken about as much. I would love to understand from you, because you would be having access, I mean, your clients must be ultra HNIs in some fashion, and in some level also access to retail client behavior as well. What's the difference, and how do you think it's impacting investor decision at your end and in the markets at large?
Yeah, that's a good question. Thank you, Neeraj. And it's been quite stark. And if you look at HNI and what you call retail in India, there has been a little bit of a difference. And maybe let's pan out over the last 18 months or so just to get a view, outside in view. So when we looked at the HNI customer, there was initially very large degree of skepticism. What is happening? Is this rebound real or not? Because they were burned and they had a lot of scars on the back from the previous crash. And that was followed by what I call reluctance in accepting the change in market environment, followed by extreme pace of deployment to catch up in equities largely. And then I think it became chasing ideas and chasing names, getting into private deals. There are a lot of deals that happened on the private markets on a lot of these unicorn companies that we hear about. So they went into those kind of private market asset classes, private equity, secondary deals, and so on. And when it comes to retail, it's been quite different. So it's been very consistent, and there has been a remarkable preference towards direct investing in stock markets. So what you call the DIY investor. So DMAT to mutual fund folio is about 5:1 ratio over the last 12 months. And obviously, a lot of money has come from mutual funds. So every month, about 15,000 odd crores comes in mutual funds, 10,000 crores is SIP. So that has been quite interesting. It's been it's actually gone steadily as we go along over the last 18 months. So they did not, they came in early and they kept building up that part of the market. And they diversified and they maybe got into cryptos and NFTs. So it's and I've heard of customers, saying, "Oh, listen, I'm doing a SIP in crypto, or I'm doing a SIP in NFT." So where they got diversified, they branched off from a HNI and retail perspective is quite different in that sense.
That's true. That's true. It's interesting. What's been the experience of your HNI and ultra HNI clients on this whole crypto investing? Because the rules are still fuzzy when it comes to India. We've not seen the black and white as yet in terms of the regulation per se, even though the inferences are out there. But what is it that people are doing largely?
Yeah, I think as far as the HNI is concerned, I have not seen very significant allocation. There has been definitely, there's been definitely a big interest. And again, we see extremes out there. Some clients who are very heavily invested and experimenting with all kind of cryptos and all. But that trend has been more pronounced, like I said, in what I call retail. And there, I think, therefore, I would like to caution investors because, see, this is, like you said, an unregulated market. It's not regulated by SEBI or, there's not a fund or so to speak. Even the platforms of the companies that are offering are not regulated properly. And therefore, there has been this huge diversion of money into, meme cryptos and so on, without perhaps understanding what is the foundation of crypto technology and all, blockchain and all. So I think that risk is out there. And that is what I would like to warn investors through your medium, that listen, don't get trapped into meme and all of those things.
True. One final question, Anshu. I mean, actually, two questions rolled into one. You mentioned that you dial back on equities a bit, but are you constructive on the way, by and large cap, high quality equity could shape up over the next 12 months in India? And and I just added into that is this pocket where a bunch of, I guess, both retail as well as HNIs would be invested in, which is the new age companies, which started off with a lot of fanfare and very good to have that sector developing in India. But somehow the prices from fintech to consumer tech to what have you have just collapsed completely from the highs.
Yeah, Neeraj, yes. So let me address the first part of your question. Yes, we are constructive on the market. Like I said, economic conditions have not changed. Demand is very strong. And I think what you call sector rotation in classic term, this is another cycle. And I mean, we all try and justify each cycle saying this one is different, but it's not. So this is just another cycle. So in 2021, you saw metals outperforming, creating a lot of profitability for Nifty. You saw IT services outperforming and creating the bulk of outperformance in profitability for Nifty. I think that is changing hand into banking, financial services, and changing hand perhaps into uh, IT will continue, but maybe the infra and the capex guys will take the bet on forward. So I think the leaders will change from a profitability perspective, and therefore it's important to assign your portfolio in that direction. I forgot to mention real estate. That is a big move that is happening right now. So maybe let me summarize the big drivers of India's growth, and that gives the audience a little bit of a flavor as to where they can assign their portfolios. So number one is the housing boom. I think that has widespread ramifications for the economy across the cycle. So we have not seen this kind of a housing boom since 2012, perhaps. So it's taken a long time coming, but right now it is in motion, and I don't think it will break unless interest rates very rapidly go up. So that is one. IT services, I mean, a lot has been spoken about, $200 billion plus of exports, rapidly scaling. But the interesting point there is additional hiring is about 160,000 professionals compared to about 80 to 90,000 professionals earlier. So the incremental income, Neeraj, that will get generated is about 1.5 trillion rupees. That's the spending power of this industry, in addition to what they generate as profitability. I think third is capex. That will be widespread. The PLI scheme and all of that will add a lot of capex to the country. So anything that is affiliated with that. And let me just now segue into the private markets and the new age, perhaps, if I may. I think this is an irreversible trend as far as India is concerned. It's just that the conditions have been so conducive, not only what you call new age, but a lot of other companies IPO'd, and the markets were willing to pay, definitely high prices. But I think these companies are here to stay. These businesses are here to stay, and they will start nudging and pushing the leaders of today. Maybe find their way into Nifty or the indices and so on. So it's a beautiful transformation of capital markets. Over the next 3 to 5 years, we'll see it. Again, I think the greatest risk is the price that you pay and not what you buy. And also extremes create opportunities for both buying and selling. And I would urge that the new age companies be looked at not from one yardstick of only profitability and all of that, but the fact that what kind of market share can this company acquire? Why do consumers love this company, and so on? And what kind of incumbency exists that they are trying to displace? I think there are a lot of opportunities that will come across, and India will have its own way. These new age companies will evolve, but it's an interesting market, an interesting segment to look at.
I have a last question, Anshu, out there. Last week we were talking to Sameer Arora, who made this very interesting point. It's actually gone viral, but he made this interesting point about how when you look at fintechs, I mean, there are a bunch of them out there with no end game necessarily in sight. Whereas if you look at maybe some consumer tech companies, the Zomato, for example, or some others, there is not a lot of companies out there. There are not too many companies coming up to displace them per se. And therefore, while there might be some value in some of those niche companies which are incumbents and large and dominating in the space, a lot of these fintech companies might not be ideally the best investments. How have you guys looked at this scape, simply because there are a bunch of them out there?
Yeah, and it perhaps maybe is a harsh statement, and I will let begin by saying that I think fintech is a little bit different when it comes to the market, because the incumbents have a big opportunity and a big advantage. So the banks and the existing insurance companies and all, they're not sitting back and saying, okay, come and disrupt me. Yeah, they're also doing their stuff. So our best banks and best insurance companies and the best asset management companies are fairly advanced from a technology perspective. And because of the regulatory framework, they have a huge advantage anyways. they have the customer base, they have the regulatory licenses that protect them, and so on. And the customer trusts them because of that. So I think, therefore, fintech, the value chain is a little different from rest of the market, like a consumer tech and direct to consumer and so on. And you'll have to break in that opportunity into parts. For example, lending is very hard. The banks are not going to vacate. They have the opportunity and the lowest cost of funding. So, and it's not easy to displace the existing borrowers of a bank, because how do you get them, right? And for that, you have to maybe break your profitability significantly. And how far can you keep funding that with equity? So therefore, like I said, the models could be very different. What could be very interesting is models like what exists in the US, like Square or PayPal. So not only payments, but the whole merchant ecosystem.
Sure.
That could be very interesting. Direct to consumer insurance could be very interesting. So there are models that can build around the Indian economy and the consumer. And therefore, I would be very happy that some of our large banks convert themselves into fintech. And that is what is going to happen anyways. When did you last visit a branch? I never visit a branch now. So we are anyways living in that world. Therefore, I think the incumbents in finance have a huge opportunity compared to other sectors.
Okay. Good having your thoughts, Anshu, and thanks for the rounded perspective. A lot of times people look at only equities. It's great to look at the views of the other asset classes, and you guys are rightly poised for that. Appreciate your time, and thanks for joining in today.
Thank you, Neeraj. Great to be with you. Thanks a lot.
Likewise. And viewers, thanks for tuning in to this edition of The Talking Point.